Welcome back to the Wednesday Policy and Property edition of the Wilton Report. And tonight we are going to talk about why homeowners are not selling and why inventory is so low. Everybody's been talking about interest rate. Tonight we're going to talk about taxes. Rates matter, but in New Jersey there is a tax story running in the background, and most homeowners don't even know what's happening to them. And a lot of buyers don't realize one of the reasons inventory is not coming to the market as readily as it should is taxes. And we're going to break that down today. So welcome back to the Wilton Report. I am Josh Wilton, and I co-own and run the #1 boutique real estate agency here in Central New Jersey. And I have helped thousands of people buy and sell real estate in this market. And I do use that experience to help you make smarter decisions. Along with my team of market specialists, we've helped thousands of people make smarter real estate decisions. Doesn't matter the neighborhood, we have the right agent for you. So what we're going to talk about tonight is taxes. So we're going to do a national level kind of conversation, and we're going to bring it back to Mercer County as well. So tonight's episode was really facilitated by the fact that about a month ago, I met with a gentleman here in Princeton and his family. And he's 93. I'm not going to give you names, but he's 93 years old. Bought his house for $85,000, right, in Princeton, long time ago, like 35, 40 years ago. The house is worth well over $2 million. And I met with him. I met with his family. And he basically said, look, I'm not selling my house. I'm going to move in with my daughter. We're going to rent this house until I'm no longer here. He's passed away, because of the tax implications. And I'm like, that's interesting. It's an issue because nobody likes to pay taxes. However, the estate strategy of renting a house, and this is on a prime street in downtown Princeton, that would sell in a minute, that's in the market's in desperate need of inventory in this price point and this neighborhood, not coming to the market. They're going to rent it because of the tax implications. And that's really what we're going to talk about tonight. So there is the national lock-in effect, and a lot of people know about it if you've subscribed to the broadcast here before. If you haven't subscribed, please do so, by the way. 60% of the mortgages in this country have rates 4% or below. I read a headline today that at least 1/3 of homeowners, there is nothing anyone can do to get them to give up their low rate, which means move, right? So those homeowners face a problem. Sell their house, and the next mortgage will cost them double. The house will probably cost them double, right? So on a $400,000 loan, right, moving from 2.65 to today's 6.46, that adds $1,265 a month to the same loan. The issue is the house that you could have bought for $800 is now $1,400. So it's not $1,265 a month. It's thousands of dollars more a month. So it becomes a very big decision whether you should sell your house. However, right, that's not the only factor as to why inventory is constrained. So one of the things that we want to talk about is that, right, home price appreciation predicates taxes. So let's talk about capital gains. It's a tax. It's a federal tax. If you buy a stock and you sell it for a profit, you pay a tax on that profit. Same thing in real estate. So here's how capital gains works. You buy an asset. You sell it at a higher price, right? The capital gains is predicated on the profit. Now, there's some rules which we're going to talk about. And New Jersey homes, the home prices in New Jersey, just since 2020 are up 46%, right? Since the pandemic surge, national prices rose 37%. Growth in our core markets is still happening. We are in a highly appreciating, highly inflationary market today, the 8th of April, right? At some point, it will slow down. I thought it was going to happen this year. The war sort of predicated inflation. In inflationary markets, people tend to buy in upward inflation. People tend to buy as a hedge. That's happening. So why it matters for taxes. A homeowner who bought in $215,000 for $350,000 and can sell it today at 700. And I realize these are not like Princeton prices. This is just easy math. That's a $350,000 gain. A married couple can use up to $500,000 as an exclusion to the tax. But someone who bought in 2010 for $300 and now can sell it for $900, right? That $600,000 gains leads $100,000 exposed to capital gains tax, and that number is growing. The capital gains is growing by the minute right now. So here's the capital gains exclusion rule. Under Section 121 of the IRS code, I looked it up, homeowners can exclude gain from the sale of a primary residence. It has to be your primary residence, not an investment property. So if you're single filer, $250,000, you can exclude. A married filer, $500,000, you can exclude. You have to have lived in the home for 2 of the last 5 years. You do have investors, myself included, who like to move around every couple of years to keep themselves nimble as a hedge against paying capital gains if they have to sell their house. They can only use the exclusion once every 2 years. It applies only to profits, not losses, right? Any gain above the exclusion cap is taxed at the capital gains rate of anywhere from 15 to 35%, depending on income, right? So, and again, there's an additional 3.8% net investment income tax if the income exceeds $250,000 married or $200,000 single. So if you make more money, you pay more taxes, just the way it works. The issue with the federal capital gains tax is that it was set in 1997 for home prices in 1997. It's never been adjusted for inflation. So if you ask an investor why they're not selling their investment property, why are they hanging on to it? The number one answer they will tell you, I am not giving the government 30 to 40% of my money, period. I've maintained it. I've paid the taxes. I put the roof on it. I did all the things. I dealt with tenants. I fixed everything along the way. If they're a good landlord, I realize not everybody's a good landlord. And I'm going to sell it, and I have to give 35% of the profit to the federal government. Investors are hanging on to investment properties, I think, longer than they ever have because they don't want to pay the capital gains tax, which was set in 97, hasn't been adjusted for 2026. And again, I'll remind you, home prices have more than like tripled in that time frame. So again, if they kept pace with inflation, the housing price exclusions would be about $750,000 for a single and about $1.4 million for married couples, right? There are bills at the federal level, but nothing's really been moving forward. And it's an issue on both sides of the aisle. I try to stay apolitical on the show. There are Democrats who realize this is a problem, and there's Republicans who realize this is a problem, and it legitimately is a problem. Taxes have their place. I'm not like an anti-tax person, but the tax law was set in 1997 for home prices in 1997. Congress has done nothing about it. So let's take an example, right? So you bought a house in Princeton for $550,000 in 2012. Current value is 1.3. The gross gain is $750,000. The married exclusion is $500,000. The taxable gain is $250,000. The federal tax is $40,000, right? Plus another 3.8%, right? So your total federal tax is about $60,000. This doesn't include New Jersey state capital gains tax, which is taxes ordinary income up to 10.75% state rate. So you're paying taxes to the federal government and in New Jersey, where we live, and if you are from New Jersey, we just kind of dig the state and all it's crazy. You pay a New Jersey state tax, right? So, the issue is people are hanging on to real estate. Now, New Jersey has amongst the highest property taxes in the U.S., right? The average homeowner pays over $10,000 a year. I realize that people in Princeton, West Windsor, Mercer County, Lawrenceville will be like, I'd love to only pay $10,000 in taxes, but that's the average for New Jersey. The national average for property taxes is $3,500 to $4,000, right? So New Jersey property taxes are higher than nearby states. And again, as a reminder, if you didn't watch the interview with Mayor Marathi in West Windsor or Mayor Frieda here in Princeton, 57% of the taxes in West Windsor go to the schools. right? So schools are self-funded by the township. So what does this mean? So the gentleman that I was talking about in townhouse bought it for about $50,000, $80,000. His tax bill would have been $400,000. And they're looking at it and go, you know what, we'll just rent it. We're going to rent it. It's not going to cost them any money. House is paid off, obviously, right? The rent will cover the taxes plus. So they're going to prep it. They're going to paint it. They're going to rent it for a year, 2 years, 3 years, whatever. And then when the time comes, they will sell it. And we'll talk about what that means. But the estate, by not selling it today, will save $400,000 in federal taxes and $100,000 in state taxes. And it prevents a much needed house in the center of town from coming to market to buy. So the reassessment trap, downsizing isn't necessarily cheaper. People are like, I'm going to downsize. But you got to think through the implication of downsizing, right? So the issue is when you downsize today, if you're leaving a 3% mortgage and you're downsizing to a 6.5% mortgage, obviously your monthly payment goes up. If you're downsizing out of your house and you're buying a smaller house, well, the smaller house has appreciated, right? So what happens is your new purchase often resets to the current market. So again, if you bought a $500,000 house and you had to bid up to $600,000, the tax implications now based on the $600,000 price. So the longtime owner theoretically is going to pay a little bit less in taxes on an older valued home. They sell and buy a smaller home. The new home is now reset to the higher market value. The tax bill is going to go up, right? So smaller homes don't necessarily have a lower cost because of the tax implications. And what we're talking about tonight is the fact that people are not putting their house on the market because they just don't want to pay the taxes. Now, why would this gentleman who's 93 and has lived in the center of town in an awesome house that everybody wants, right? He can walk to everything. Why wouldn't he just sell it, right? Why would he hang on to it and have the estate deal with it? Well, now we're going to talk about the step-up basis, right? So this is New Jersey specific. When a homeowner passes away, the heirs inherit the property at its current fair market value. So in this case, this gentleman bought the house, let's just say for $80,000, right? It's now, he passes away, it's worth $2 million. So now when the heirs of the estate inherit it, it's worth $2 million. It's the stepped up value, the stepped up basis of the house. It eliminates capital gains from the original purchase. There is no more capital gains because now it's worth $2 million. The heirs are only taxed on gains after inheritance. So it can reduce or eliminate some large tax bills. And that's exactly what their strategy is. And I've been hearing about it more and more and more, where people are keeping their house in Princeton, right? The rental volume has gone up in Princeton. They're not selling. This is a big reason why, because they don't want to pay the federal government hundreds of thousands of dollars on this house they bought for $80,000 30 years ago. And it's a big part of estate planning today. So you bought the house at a much lower price. It resets to a higher price today. The basis resets at inheritance. So again, when you sell it immediately, there's little to no capital gains tax because you're selling it from that $2 million mark in this particular instance. So for the estate, for the person doing strategic estate planning, you're not selling that house. You're just, you know what? I'm just going to hang on to it. I'm going to rent it. I'll go do whatever, but I'm going to rent this house. So this is very relevant in high equity markets like Princeton, like West Windsor, like Lawrenceville, like Montgomery. So, you see people that are hanging on to their houses way past where they normally would have. You also see investors who bought a house for $100,000. It's now worth $400,000. And again, they've been collecting rent, but they've been paying the taxes. They've been paying the upkeep. So when they sell that house, they get taxed on the profit of $300,000. There is no exemption for that for being married or single or $500,000. You just pay on the profit. So investors are like, you know what? I refinanced it down from a 10% rate to a 2% rate or a 3% rate, or the house is worth so much more money. I'm just going to keep hanging on to it. I'm not going to sell it. So the tax trap is another reason that the market is as tight as it is. Investors are hanging on to properties way longer than they have in the past. Homeowners are holding on to properties way longer than they have in the past. And a big reason is people don't want to pay the federal taxes. And in New Jersey's case, the New Jersey taxes. So it's part of the issue overall in the market. So if there's any questions, I would say put them in the thread. I'm happy to answer them. But again, that's what we really wanted to talk about tonight on the Wilton Report. It's not just the lock-in effect on rates that's the problem. The lock-in effect is everything that's the problem. Like, it's everything that's the problem. So, when you look at what's happening in the market, right? Do you think that the federal capital gains rate in real estate should be adjusted from 1997 to 2026? It would make sense. And I guarantee you, if the federal government said, we're going to have an exemption, and for 6 months, the first 10,000 investors nationally, if they put their houses on the market to alleviate the housing shortage, right? That at least we're seeing in the northeast part of the state, of the country. People would take advantage of it because they're like, it's an investment vehicle, and they want to cash out at maximum equity. So what do you think? Should the federal capital gains rate for real estate be adjusted? I personally think so. You can leave your thoughts in the comments. Again, if you haven't hit subscribe to this channel, whatever channel you're on. And we talk about real estate every week here on the Wilton Report. Thank you for tuning in. I appreciate it. My name is Josh Wilton. And again, this is the Wilton Report. And I will see you next time we go live. Thanks, everybody.